Hello, hi everyone. Yeah, welcome to AK 201 lecture for week 2. I'm going to discuss a new topic that is fair value measurement. I'm using a PowerPoint slide from Loftus textbook. So as we know, the fair value measurement is really the key concept in international financial reporting standards. For certain countries who adopted the FRS, so we have to move from the old measurements or regime of valuing the assets and liability to the fair value measurements. Yeah. So I still remember when I was teaching in Malaysia in year 2005, 2006, we started adopted IFRS. So this fair value management is a new concept that transforms the reporting of accountings. So it's depend on your home country whether you already adopted the IFRS or not. But certain country they might be late in adopting the standard. But I think most of the country now already use the International Financial Reporting Standard. So what is the fair value measurement? When we learn AK 111 or AK 112, the basic accounting, we record asset at the price or at the value when we acquire the assets. When we so it's based on historical cost conventions. So later on, we found that the value reported might not be correct over time. Yeah, after certain years, the value has increases or has increased or has decreased. So we need to do some remeasurements. Okay, in case of acquisition, you buy or you acquire another entity. So how are you going to value? How are you going to measure? How are you going to record the value of the asset liability of the company that you acquired? So that is where we need to discuss this topic carefully. And I'm going to spend the first 1 hour, explaining the concept, the definition of the fair value measurement. In the second hour, inshallah, I will do two questions about liability, how to measure the fair value of liabilities, and then I'm going to continue. I'm going to wrap up with the last part of the theoretical or explanation about the fair value measurement. So we're going to have three sessions. The first one is about the basic idea what is fair value measurement, and we're going to do two questions, and then I'm going to wrap up with the disclosure, what are the requirements to report the fair value in our financial statement. That is a question, whether the asset, the revaluation surplus is part of the revaluation, the part of the fair value. Yes, that is one idea, one treatment consistent with the fair value measurement. We want to report the PPE, property, plant, and equipment at a fair price. Okay, let us go to the lesson outline. What I'm going to cover today. Number one, I'm going to identify the need for an accounting standard on fair value measurement. Why we need fair value measurement. Okay. Number two is I'm going to explain the definition of fair value accounting. Okay, what does it mean by fair value? What is the difference between fair value and the previous concept, the historical cost? Measure the fair value of non-financial assets. What is non-financial asset? If you have a 100 dirham note, that is financial asset. Financial, some country they use financial asset. So you don't have to value. The value of the $100 or 100 dirham note is 100 dirham. So you don't need to value. But if you have a building that's non-financial assets, you want to know what is the value of that asset. What are the value that should be reported for each classes of assets? So apply the fair value measurements. You're going to apply the fair value measurements, okay, to the liability as well. To the liability, we have a liability. We borrow money from the bank, or you issue debentures or bond to cover your operations. So we want to measure what is the correct value in determining what is the correct value of liability that should be reported in our financial statement. This is more advanced. It's not about debit and credit. It's more on the process of identifying the fair value. Okay. Next is explain some of the issues relating to financial instrument. Yeah. And finally, is we're going to see how we're going to report or disclose information about assets and liability in our balance sheet. So how are we going to put that disclosure? Okay. So as I mentioned before, these IFRS come, this fair value measurement come with the International Financial Reporting Standard. So it explains the meanings, okay, or the fair value as set up in the AASB, Australian Accounting Standard Board number 13, or IFRS number 13, about the fair value measurement. So the concept of fair value is important because it is widely used in other standards. We have, for example, PPE. We did PPE during our AQ200, the revaluations and so on. So how are we going to measure that PPE? Intangible assets, we have intangible asset research and development, for example. Yeah, impairment of assets, employee benefits. Okay, so all these standards use fair value measurement. Leases. Okay. Exploration and evaluation of mineral resources. This is for oil and gas, E&E, exploration and evaluation of mineral resources. For example, this is not oil and gas. Normally, oil and gas industry, you have to know this accounting standard. We don't cover that. We don't cover that in our syllabus, but I think we should include this also. Yeah, exploration for and evaluation for mineral resources, and then IS 40 about investment property, agriculture, financial instrument, share-based payment, revenue from contract with customer. So all these accounting standards, they use fair value measurement. So I'm going to explain IFRS number 13 today, so it help you to have a clear picture. What does it mean by the fair value in all these standards? Not only this, they have more standards about non-current asset held for sale, financial instrument, business combination, consolidated and separate financial statement, accounting for government grant, contribution, superannuation. So all these standards use fair value measurements. All these standards use fair value measurements. Okay. So in Australia, companies have been allowed to use fair value for measurement of certain non-current asset for many years. In the US, however, the SEC, the Security Exchange Commissions, remove the option for upward revaluation. So in the US, you are not allowed to revalue the asset upward. So that is the challenge. But fair value to acquisition and contract entered by companies. So when you have the acquisition process, A acquire B, you are allowed to use the fair value measurement. So that is the introductions. Yeah. However, because of this accounting scandal, maybe world.com, Enron, yeah. So there are big pressure. There are huge pressure to come up with a fair value measurement. We don't want to record things at historical cost. We want to have a clear guideline. What is the process? What is meant by the fair value measurement? How we are going to apply that? How are we going to report the value in our financial statement? Because of this pressure, yeah, the IASB in year 2011, yeah, produced one standard, specific standard, IFRS number 13, to clearly spell out what is the fair value measurement. Even though it has been mentioned in the previous accounting standard, but in May 2011, because of this standard, the pressure, so the IASB, the International Accounting Standard Board, produced or issued this IFRS number 13. So in Australia, there is 4 months after that, they adopted the IFRS number 13 and issued or renamed it into AASB number 13. So this is the standard that we're going to discuss today. So ASB number 13 or IFRS number 13 has three objectives. Standard. It's going to define what is fair value. What is fair value? What is mean by fair value? Set out framework for measuring the fair value. How to measure fair value? And number three, put standards about, not standards, we've got a guideline about disclosure of fair value measurement. So this is the objective of issuing this standard. So some restrictions still exist, does not impact the fair value as required measurement method. It's not 100% applied, but they have some restriction there in certain standard. What is mean by fair value? Okay, the price that will be received, to sell an asset. When you sell the asset, what is the price you're going to receive? Or in case of liability, the amount paid to transfer a liability in orderly transaction. The word here is orderly transaction between market participant at the measurement date. So that is the fair value. I'll give you a simple example. Simple examples. Simple examples. You have your okay. I couldn't see my video. Can you see me? Okay. Should be okay now. Okay. So, for example, you have your vehicles, your car. You purchase the car, maybe Porsche, or Mercedes at price maybe 200,000 dirham. That is your purchase price. Later on, after 3 years, the value should not be 200,000 anymore. The value will decrease. Am I right? So we have two prices. Number one is your purchase price. That is your purchase price. You bought the car at price of 200,000 dirham. And then we want to know what is the fair value. How are we going to know the fair value of that car? The fair value is the amount you're going to receive if you sell that car. Now, how much you're going to get? No, it's not 200,000. It's going to be less than that. All right. Okay. In orderly transactions, mean you're selling the car, to the third party, not to your brother, not to your mom, between market participants, mean to the third party at a certain measurement date. So that is what we call as the fair value. The amount you're going to receive, the price that you're going to receive, if you sell the car or to the market participant at measurement date. It cannot be you sell the car to your brother, you sell the car to your wife. It doesn't work like that. So that is not the value that we want to know. So you need to determine what is the fair value. The fair value is what if, hypothetically, assuming that you sell the car now, what will be the value of that asset? So that is what it's mean by the fair value. If you have liability, you borrow money from the bank, maybe for your study or to buy assets. If you want to settle the liability, transfer back the liability from you to the bank, mean you pay the bank, you're going to pay the bank. How much you have to pay? How much you have to pay? Now, so that is what we call as the amount, the price paid to transfer liability to the third party, to the bank, for example, or to the lender, So that is the fair value. Okay. The measurement for fair value is based on hypothetical transactions. There are three elements. The first one is at the current exit price. Exit price means you want to sell the items, That is the exit price. You sell the items or dispose the liability. So that is the exit price. Okay. The asset is sold or the liability is transferred in an orderly transactions. And the transaction is between market participants, between the buyer and the seller, between the buyer and the seller. So that is the three elements of the fair value: the exit price, the price to sell the assets, the price to transfer the liability. Okay. Okay, what is the exit price? The price that would be received to sell an asset or paid to transfer the liability. So that is the exit price. So based on the perspective of the entity that hold the asset or own the liability, it's about the expectation about future cash flow that would be generated by the asset or liability subsequent to the transfer of sales. For example, if you have a car, you want to dispose the car. This is your car. You have a car, or you have a building. Yeah, your building. This is your PPE building there. The cost is 100 million. You purchase, this is your purchase price. Purchase price. Now, if you transfer that building or sell that building, this is the sell mean exit. You can get 150 million, but you need to pay certain tax for agent, yeah, another 15 million. So the fair value of that asset actually is the fair value less cost to sell will be 135 million. This is the fair value less cost to sell the asset. Yeah, 135 million. So this is the amount that you should record in your financial statement. What is the entry price? Entry price is the amount paid by the entity to acquire an asset or assume liability in exchange transaction. Entry price, when you buy the assets and we take loan, so that is the entry price. Whereas the exit price is the fair value of the acquired asset or assumed liability, yeah, is the price that would be received by the entity when it sold the asset or paid to transfer the asset to another company. When you acquire the asset, okay, when you sold the assets, yeah, when you sold the asset or you paid the liability, what will be the price? So that is the exit price. Orderly transaction, it means that a transaction that assumes exposure to the market for a period before the measurement date to allow the marketing activity that are usual and customary for transaction involving such asset or liability is not a forced transaction. Forced transaction in terms of, for example, bankruptcy or liquidation, that is we call it as the forced selling. Forced selling means you don't have enough time to find the buyer. So that's why if you want to buy the asset, one way of getting a cheaper asset is by buying from auction because the price is much cheaper. Maybe, yeah. I did purchase two assets using auction or using this, we call it forced selling, mean the asset being auctioned by the bank because the previous owner not able to serve the loan, so the price is much cheaper compared to the open market. Yeah. So, for example, if you want to buy a car, yeah, you can go to Dubizzle, all right, Dubizzle, yeah. there are many cars available there. Yeah, you can see some of the car might be listed for 1 week. Some might say already 2 weeks there. So from there, you can know what is the value, what is the price of the car if you want to dispose your own car. But in certain situation, you can see that they have this urgent sale. I'm moving out. Yeah, I'm moving to from UAE, so I need to sell the car. Yeah, only 3 days. Okay, so that will be very, very urgent. That is called it as force, not force, but distress sale. Distress sale. We don't use that distress sale, but we use more orderly transactions. Yeah. The entity will make observation about current market containing orderly transaction. Factors that indicate non-orderly transaction are the seller is in or near bankruptcy. In or near bankruptcy. So they don't have enough time to find good buyer for the assets. The seller was forced to sell to meet regulatory requirements. Yeah, this is by court order or by legal requirement. They have to leave the country, so they need to sell the asset. So that is not considered as orderly. It falls under non-orderly transactions. If the transaction is not orderly, the amount paid will not necessarily equal to the fair value. So under non-orderly is not the fair value. The price is not fair value. So what is market participant? The third element, same concept as knowledgeable. Okay, willing parties in arm's length transactions. Arm's length means it's not between you and your immediate family or your immediate groups. Yeah, need to meet this criteria. Be independent. Be independent. Be knowledgeable about the asset or liability. Have the ability to enter into the transaction, not be forced or compelled. So this is what we call as market participant. Market participant. So the entity need to consider factors specific to the transaction, such as the actual asset or liability being measured. What is the assets? Yeah, if they can have a look at the assets, they visit the building, the property, the principal or most advantageous market for the asset and liability, where you can get good price for the assets or liability. The market participant with whom the entity would enter into transaction in that market. So we need the market participants, yeah. We need the principal market as well as the assets, yeah. So how about the transaction or transportation costs? For example, if you have asset, you need to pay for the agent, you need to pay certain amounts to the company that advertise the asset. If you sell your asset through the Weasel, I think they charge you a certain amount of money too. So that will be considered as transaction costs. Or if you that asset you need to deliver to your customer, that fall under transportation cost. So this is cost to sell. I call it the cost to sell. Cost to sell the assets. Okay, or transfer liability in the principal market for the asset or liability that are directly attributable to the disposal of asset or transfer of liability. For example, I told you we're going to sell our building 150 million, but we have some cost involved there, 15 million. So this is cost to sell. Cost to sell. This is the fair value. So after deducting the cost to sell, the value will be 135 million. This is fair value less cost to sell. Cost to sell, or maybe including the transportations, transaction cost involved. Yeah. So the transaction cost, okay, what is meant by transaction cost? The result directly from and are essential to the transaction. This, if you want to perform the transaction, you have to pay for the cost. So that is your transaction cost. This would have been incurred by the entity had decisions to sell the asset or transfer the liability not been, not been made. Transport cost, the cost that will be incurred to transport an asset from its current location to its principal market. So that is the transportation cost. You have to bring the assets from your home, for example, from your home to the markets or to certain site. So that cost is considered as transportation cost. Okay. For biological assets, biological assets. I don't see much in Dubai, for example. If you have cattle, cows, yeah, chicken or whatever, you have a farm. What is the value of that assets? Your chicken, your cow, yeah. So your all these biological assets. Or if you have fish, for example, yeah, if you involve in this kind of business, you must have you can see that the assets, the biological assets grow, yeah, grow in size. So you need to determine the value. What is the value of 2 years old cow? Yeah, or 3 years old cow. So how are you going to value that? So we need to value the exit price. At the same time, you have to incur the transportation cost to bring the asset, for example, fish, prawn, from your farm to the active market, So that is considered as transportation cost. So it's going to be deducted from the fair value from the exit price, exit cost. Okay. Are you okay with this? Okay, I'm going to continue about the application of fair values. So how are we going to apply that? Number one, you need to distinguish between financial assets and non-financial assets. What is financial asset? What is non-financial asset? The most common financial asset is cash, your cash note. That is your financial assets, or shares in other entities and right to receive shares from other entities. For example, you have your investment, you have your fixed deposit in your bank. Yeah, there's a value there. When you put money into the bank for the fixed deposit or investment, the value is 10,000 dirham. So that is your value. You will not get 12,000. They will give you return as dividend, but you don't have to measure what is my fair value of my money in the bank is still the same as what being reported or being what is available in your account. So that is the financial assets. Yeah, your cash balance will always be like that. Yeah. So we use that figure as our fair values. So the reported figure is equal to the fair values. Other than that, we have non-financial assets. For example, property, plant and equipment, intangible. So all this is non-financial assets. Yeah, non-financial asset. Yeah, property, plant and equipment, for example, intangible, your research and development, that is not your financial assets. Okay. What is the step to make a fair value measurement for non-financial assets? Number one, you need to determine the particular asset that is the subject of the measurement. Which asset you want to measure? You want to measure the fair value of your building, for example, your house. Yeah. Determine the valuation premise that is appropriate for the measurement. How are you going to measure that? How are you going to measure that? What is the best way to get the fair value? Determine the principal or most advantageous market for the asset. If you have a car, where is the best place to sell the car? You can buy the car, you can sell the car through Dubizzle, maybe. Maybe there are several other websites, I'm not sure. Maybe there are certain company they advertise, sell your car here, or you can put it in your Facebook, your Instagram. I'm not sure. Maybe you can go to the third party, to the second-hand car dealer, just give them your car, just show your car, and then they will test drive your car and then give you the price. So that is from these markets, different markets, from Dubizzle, from Sell Your Car, from another one, from the second-hand car dealer, or do your own advertisement. Which one is the most advantageous? Which one offer good price? Which one offer good price? You know better than me. I think the second-hand car dealer, they won't buy good price. Maybe the price is 20% or 25% lower if you can get it from the diesel, but it's up to you. You know better than me. Yeah. So you need to determine the principal market. Why is it the principal? The most advantageous market, mean market that give you the highest price. Determine the valuation techniques, yeah, appropriate for that measurement. So this is the process involved. Okay. Step number 1. What is the particular asset being measured? Consider particular characteristic of the asset that is relevant to the market participant and pricing. So we want to know the location of that asset, where the asset was situated. What is the condition of the asset? Whether it's used, how many years it has been used, okay, whether there are damage, whether there are any problem with the asset, are there any restriction on sale or use of the assets? Okay. Is the asset or liability a stand-alone asset, or is it a group of assets? Stand-alone asset, for example, car. Yeah, car. That's a stand-alone asset. Yeah. But if you're talking about airplanes, yeah, Boeing, for example, 777, you have many assets there. Yeah, they have this engine, they have this the body of the airplanes, they have this navigation system, they have so many things. So are they going to sell you the asset as a standalone unit? I'm selling the engine only, I'm selling the cockpit only, or are you going to sell it as a group of assets? Yeah, as a group of assets. Okay, same goes to the building. Are you going to sell that your house as a unit, or you're going to include all the furniture, all the things inside the house? Okay, is a group or standalone assets. Why is the appropriate measurement valuation premise? Okay, so the fair value is measured by considering the highest or the best, the highest and best use of asset. So the use of non-financial asset by market participant would maximize the value of the asset or the group of asset within which the asset be used. So that is how we are going to do that. Yeah, the highest and best use of assets. Highest and best use must be physically possible, legally and financially. Okay, but the highest and the best, it refers to physically, legally and financially. Okay, in combination of valuation premise, the highest and best use of asset is where the market participant obtain maximum value through the use of asset in combination with other asset as a group. So if you have these assets, only the engine of the airplanes, Boeing 777, is not the best use, the best value you can get. If you can buy, you sell the asset as a combination of assets, the price will be higher, So in that case, you need to determine what is the combination or combined value of that assets. Okay. Some asset you cannot survive at its own. You have to depend on other types of assets. Okay. So standalone valuation premise is the highest and best use of asset is where market participant obtain maximum value from using the asset on a standalone basis. That is another way, standalone or combination of assets. What is the principal or most advantageous market? Okay. The standard assume that the transaction to sell the asset take place in the principal market for the asset. If you don't have the principal market, then the most advantageous market for the asset. So either principal market, if there is any main market there, so what is the value if you can get from there? Another one is the most advantageous market. Most advantageous market. For example, as I mentioned about selling car, you can go to Bibizel, sell your car, maybe from your Facebook, Insta, or you can go to the second-hand car dealer and ask for the price. So you need to determine what is the principal market, what is the normally people, how people sell their car in UAE, in Dubai. Yeah. The principal market is the market with the greatest volume and level of activity for the asset or liability. Okay, that's the principal market. The most advantageous market is a market that maximizes the amount that would be received to sell the asset or minimize the amount that would be paid to transfer the liability after taking into account transaction costs and transportation costs. So most advantageous and also the principal market. Which one? Yeah. What is the appropriate valuation technique for measurement of the asset? We need to estimate the price. Estimate the price in orderly transaction between the market participant already determine the nature of the asset, the valuation premise, and also the principal market. If you still, if you are aware, if you use this website, for example, Dubizzle, for searching for cars, for example, I did that a few months ago, yeah, when I want to buy my car. So you for example, you are looking for Mercedes-Benz car, yeah, and for a certain number of years, you have this function years, you have function location, you have this other function, whether that is GCC spec, whether that is from US spec, okay. So you have all these criteria, and then you can, when you put a filter, they will give you the list of asset fulfilling your criteria. So by having this information, it helps you to determine what is the range of value for your asset. If you want to sell a car, so you know this should be the range. And some of them, if you click the seller, there's a note that already sold. After 2 or 3 days already sold. So you know that the price should be somewhere that price, advertised price. So that's how it works, yeah. But if you see the car sell at higher price after 2 months still there, mean that is not the correct price. That is not the good exit price for the assets. Okay. So what is the appropriate valuation techniques? Okay. So entity must use valuation technique to measure the fair value that are appropriate to the circumstances. They must have sufficient data available, maximize the use of relevant observable input, and minimize the use of unobservable input. So you need to have some information there. You need to have some information. What is the correct price, the fair value for the assets? Okay, the next one is the market approach valuation technique. Valuation technique that use prices and other relevant information generated by the market transaction. We look at the market transactions. Okay. Previously, how much they sell, how much they, what is the price when the seller sold the asset. So that is more on the market price. They use the market data. The cost price is another way. If you cannot have that market approach, use the cost approach. Valuation technique that reflect the amount that would be required currently to replace the service capacity of the assets. If you want to buy the assets, okay, how much you need to pay. Yeah, you want to replace your existing asset, how much you need to pay. So that is, we call it as the cost approach. Cost approach. So another approach is the income approach. If you cannot use your market approach or cost approach, another way you can do is by using the income approach, where we're going to calculate, estimate the cash flow. We're going to estimate the cash flow. Okay, you're going to estimate the cash flow. From there, what will be the income generated from using that assets, or cost saved from using that asset. So you're going to draw the timeline and then going to discount all that amount, the cash inflow and outflow. From there, you will determine the present value. From there, you determine the present value. But this require special judgment, yeah, special judgment. So choice of technique will depend on the circumstances, the data availability, whether you can see the observable, whether you have this observable or non-observable input. What is observable and non-observable input? For observable input is input that are developed using market data. For example, publicly available information. Dubizel, you have all these informations, yeah? Such as publicly available information about the actual event or transaction, and that reflect the assumptions that market participant would use when pricing the asset or liability. So that is observable input. But the most difficult will be the unobservable input, input for which market data are not available and that are developed using best information available about the assumption that market participant would use when pricing the asset or liability. So if you cannot have this information, you have to come up with your own judgment, intuition. What are the factors that will influence the fair value of the asset? From there, you work out the figure, and hopefully the market will also see it the same way as you, and then so there'll be not much difference between the figure calculated by you and also by the potential buyer, potential buyer of that asset. Okay, I still remember my experience. Yeah, when I purchased a property, we don't have much cash. So what I did is we borrowed money from the bank. So the bank officer, before they approve the loan, they will need to check the value of the assets. Okay, are you aware of that? You want to buy a villa, for example, in Dubai, you might need to borrow money unless you have enough cash. You don't have to apply loans. But if you want to apply loans, yeah, so the banker will need to know the location of the assets, the type of assets. They want to look at the documents, okay, the floor plan, how many rooms, how many bedrooms, how many washroom, yeah, how many, yeah. So that is the information they need. And from there, for example, you want to buy the asset at price of 2 million. Price is 2 million. You want to buy the asset at price of 2 million. So how are you going to do that? You will apply the loan from the bank, and the bank will give you the money. They don't give you straight away, but they have to do their valuation. They want to make sure what is the reasonable price, the fair value for that building. So one way is by looking at the system. They have this integrated computer system in Malaysia. So they have this location, they enter the location, they enter the type of the house, so that the system will retrieve the last transactions. For example, the last transaction involved mean before this last 2 months, there is a person who took the loan from the bank, and the loan amount is this. The selling price is between this is, for example, 1.8 million 2 months ago. So they have that information based on observable input. The value of that property 2 months ago is 1.8 million. So the unobservable input is something that we experience now. We're not sure whether the price is going up or going down, but many people will do their calculation. Okay, maybe after the Dubai Expo, many visitors will come to Dubai, stay in Dubai, so they expect the value of the asset will go up as well, because maybe because of the Expo effect, or maybe because of this COVID-19, not COVID-19 or COVID 2021, 22. Yeah, the COVID problems already solved. Yeah, so many people will come, the economy will boom and so on. So that is the unobservable input based on your assumptions. So the bank will approve, say, yes, this 2 million is a good value, so we can give you loan for 2 million to buy that asset. So that's how it works. Yeah. Okay. So what is the appropriate valuation technique for measurement of the assets? For your information, there are three level of fair value. We got it L1, L2, L3. L1, L2, L3. Okay, what is L1? L1 is the quoted price, unadjusted in active market for identical asset, similar asset or liability that the entity can access at the measurement date. If you want to sell their car, for example, they give you, this is the price, the quoted price. Yeah, the quoted price. This is the price in active market. Yeah. So that is L1, L1, call it L1. Very good, high quality. This is the L1, yeah, okay. And then L2, level 2 is if you don't have these active markets, how are you going to do it? Okay. Input other than quoted price included within level 1 that are observable for the asset either directly or indirectly. We don't have the quoted price, so what will be the observable value or observable value of the price based on observable data? Okay, for example, finished good, inventory at retail store, building held and used, and cash generating unit. So you want to check what will be the value for that asset. And level 3 is the unobservable input for the asset or liability. Unobservable. You cannot do the calculations there. So you have to do your judgment, your valuation. You have to estimate about the cash flow, yeah, the future cash flow or outflow to see what is the value from that. So this is based on unobservable input. Okay. So the measurement of liability at cost, yeah, I'm talking about liability now. Asset is straightforward. Yeah. For liability, you took a loan, you have a borrowings, you have a bond, maybe 2 million. So you want to know what is the value of your liability. Yes, in your accounts, yes, your liability is 2 million. If you want to settle, if you want to pay the liability, what will be the price? What will be the price you need to transfer? What is the cash, the amount of cash that you need to transfer? So in that case, we're going to use the present obligation. The present means you're going to discount all the future commitment to your year-end date. So the measurement of liability at cost is based on the amount required to settle the present obligation. The fair value is the amount paid to transfer a liability. The fair value is amount paid to transfer a liability. So fair value measurement assume that the liability is transferred to another market participant at the measurement date. If you have borrow money from the bank, so you transfer back the liability to the bank. If you have a debentures or bondholders, you're going to transfer the liability to the debentures or bondholders. So you don't have the liability anymore, in a simple word. So the ASB notes that the fair value of liability from the perspective of market participant who owe the liability is the same regardless of whether it is settled or transferred. So we want to make sure if you settle the liability, you pay your liability, what is the amount? So that is the fair value. So the fair value in the perspective, in your perspective, that if you settle that, how much you need to pay and whether you're going to transfer or settle that amount. Sorry about that. Okay, so we have this corresponding asset approach. There is often an observable market and quoted price may be obtained to measure the fair value of liability. So some of these liability, they relates to the assets. Yeah. So measurement will depend on whether there is or there is not corresponding asset type we held by another entities. Okay. So measurement should be in the following order for corresponding asset: the quoted price of the asset in an active market, or the quoted price of asset in inactive market, or in apply valuation under techniques such as income or market approach. I'm going to show you this, how we're going to do this. Yeah. For non-corresponding asset, measurement must be done by applying evaluation techniques from a perspective of market participant that owe the liability. So we're going to use the present value technique. So I'm going to show you example after this, example 3.8 from your textbook. Yeah. Okay. So I'm going to continue after this. I'm going to show you something first. Yeah. Sorry. Example first. Is it okay?